right, gang. Welcome back to the show. Listen, glad you stopped by. This is the Unique Trading Group, and I'm Coach UV. And today I got a special jam-packed video for those who've been wondering about trading terms over the years, different languages and different words that's been used as trading explained. This video is for you, all right? We want to peel back the layer, peel back the onion, and give you guys some clarity. That's right, some clarity on some trading terms. And this is a highly requested video, right? So we're going to get straight to it. First, in front of you, you see The Power of Patience. This is the book that I published for the trading community last year, and it is still relevant to this day. The subtitle is Mastering the Emotions in Trading While Turning Discipline into Income. That says a lot. And as you can see, cleverly, pay is stitched inside of patience, pay, right? You see, P-A-Y. All right. Now that means something because patience really does pays. And here's a blurb. If you want to read it, rewind it, take a screenshot and check it out later, you can do that just to get an idea on where I'm going with the book and what it's about. I think it's very helpful. I won't read it now. All right, and want to hop over here to YouTube. I want you guys to see this here is my beginner playlist on my channel. If you want to see, right here is the channel. And I want to quickly say thank you for those who have been watching my videos and subscribing to the channel, dedicated watching some of this content. It really does mean a lot. You guys have been there time after time watching these videos day in and day out, and I really do appreciate the time that you put in, and that's why I want to continue to give you value. So do me a favor, if you have, smash the like button. That's right, smash the like button if you've been enjoying this content, and consider subscribing to the channel. That way you don't miss any of these valuable drops. You don't want to miss these drops. Now back with the beginner talk. Okay, this is a playlist. If you guys want to scroll down and check out this how-to beginner playlist. If you're a beginner, right, there's some valuable information there to start there. If you're just joining me this year, all right, those who've been with me, all right, still always good to do some refreshers. And of course, we got the trading psychology. This is the discipline files. Very important. All right, you don't want to waste another year or two going through a lot of hoopla trying to learn how to trade. I'm trying to save you some time, so do yourself a favor, go check out the videos when you get time. Set aside some time for yourself and check out some of these that you can see here. That we have how to turn discipline into income, the hidden secrets revealed, FOMC talk. It's about the Feds and data being released, right, about inflation and different things like that. The 3-day types every trader must know, how to read candlesticks. All right, these are really good signals for you, and a channel for you to seep in and home in and get some really good education and be entertained at the same time. All right, so back to the lesson at hand. Today we're going to be reading from my book. These are trading terms explained. So I'm going to give you a couple terms, not too many, but some things that you guys will want to know. That way, if you ever wanted to follow along with my channel, you guys won't be confused. So get your notes ready, get your recording ready. All right, here we go. All right, so right here in front of you. All right, so these are important trading terms and definitions to get familiar with. And before I start, I just want to say, I know sometimes it could get pretty complicated and confusing with these trading terms. Trust me, I know. And so I want to, like I said, peel back the layer and open your eyes to a couple of terms that you may have heard of or may not. All right. So first and foremost on the list, we have the bid and the ask. All right, the bid and the ask. The bid and the ask are very important things to consider when placing a trade. And remember, the market is like an auction. All right, buyers and sellers trying to agree on a price. So the bid is the highest price the bid is the highest price a buyer is willing to pay for security, while the ask is the lowest price a seller is willing to accept. All right. Spread, the difference between the bid and the ask price of security. Okay, that's what a spread is, the difference between the bid and ask price of a security. All right, and you also have leverage. Leverage is using borrowed money to increase the potential return on an investment. So for an example, if you open up a Fidelity account or a Thinkorswim or a Webull account, there's an brokerage account you can open up, right? An individual account or a Roth IRA. And there's an option for you to turn on what they call margin. And margin gives you leverage, all right? So for example, if you put in $2,000, that's right, $2,000, they'll give you an additional investment and double that. So they'll give you an extra $2,000 or extra 3 or 4 grand, depending on the brokerage you open up. All right. So leverage gives you the opportunity to use some of the money and make a return on that borrowed money. Now, there are risks involved, so remember that. Okay. And there'll be a part 2 for this, just in case you guys still don't understand, how to apply these, right? Bid and ask. These are definitions, but we can apply some of these to the charts. All right. Volatility. Guys heard this before, right? Volatility, the degree of fluctuation in the price of a security. All right. Up and down, wild swings like a Tesla. All right. SPY, it swings up and down a lot of points throughout the weeks, the months, and the days. And so that's what traders mean when they say volatility. It just means volume, a lot of wild swings. Price is subject to swing and move a lot in different directions. Okay. Volatility. All right. Market order. Market order is an order to buy or sell a security at a current market price. All right. So this is an order you do when you don't want to wait for a limit order. All right. The limit order is telling the computer, your brokerage account. The limit order is telling it when to get in, when to get out, and how much you want to spend at a click of a button. But sometimes you don't get filled because you're trying to get a certain price. When you do the market order, this means you don't care what price. It's just going to fill you at whatever the market can go. And sometimes that's not a good thing because you always want to think risk to reward. All right. Can I get the cheapest price to make the biggest reward? You want to think about that. So a market order is an order to buy or sell a security at that current market price. All right. You're not trying to get a specific price. Just fill me when you're trying to do day trading or scalping. All right. Limit order, an order to buy or sell a security at a specific price or better. There's a subtle difference. We just explained that, right? Stop loss order. Very, very important, all right? Stop loss order is an order to sell a security when it reaches a certain price used to limit potential loss, okay? So, for instance, if you guys were to get into a trade, let's say you wanted to get into a trade here, all right? And you entered into a trade and you were saying that you wanted to make money towards the upside, all right? So if you wanted to make money towards the upside and you got into a trade, let's say you entered in at the bottom of this candle here, all right? This yellow line represents where you click the button on your brokerage account or your phone and you entered into the trade to go higher, right? Your stop loss would be below this bar, okay? It would be below the bar. That yellow line here, okay? You put your stop loss just below that bar, okay? Stop for red. We can make it red and make it fun. And this will be where your stop loss will be just in case price comes against you. It'll stop you out at right where you got in. So you're not losing money. You're breaking even. And, of course, that trader, whoever traded, they made money towards the upside, all right? That's a small example. And also, just quickly, pattern recognition is not something that we're talking about in this video. But right here is a classic head and shoulders pattern, which is a bullish pattern, meaning that the bears are exhausted and price is going to return towards the upside. So you see these areas, you have a shoulder, a head, and you have a shoulder, all right? This is a bullish pattern, meaning price continue towards the upside. Just wanted to show you that real quick, all right? On a 5-minute chart on SPY. Now, let's get over back to the trading terms. All right. We just talked about stop loss order, take profit order. All right, so in order to sell a security when it reaches a certain price, used to lock in profits. See, this order here is on the same screen whenever you place a order. It has the stop loss and the limit, and these are a triple order right here together. All right, and I actually teach this. I have a mentoring group that I do. You can check out that link below if you want to do some scheduling for one-on-one coaching, where I actually teach traders before the market open and while we're live how to do a one-button click order. So tell the market what to do with one click, all right, and lock in your profit as the money goes in your account and the market moves in the way you intended it. All right. So take profit order tells the market when to take you out, when it's going in the direction you want it to go in. All right. Lock in those profits. All right. And that reminds me of the Trader's Creed. That's also a part of my Discord. I didn't create it, but it's from Mark Douglas in a book that he wrote called Trading in the Zone, and also The Disciplined Trader. He talks about these core principles, the Trader's Creed, and I'll let you guys know about that. Let me know if you're interested, and I'll do a video about it. But we do teach this, and we go over this inside of the Discord. Again, that link is below. All right, so the Trader's Creed talks about locking in profits. All right, here we go. Technical analysis, the study of past market data to identify patterns and predict future price movements. technical analysis. All right, this is what I just showed you on that chart, that head and shoulders, those candlesticks structure. That would be technical analysis. Your analysis is coming from the technical patterns on the chart. All right, fundamental analysis. All right, this is a little different because it's dealing with a company who's profitable and is not profitable. So you're not looking at a chart per se. You're looking at the balance sheet. All right, how much debt do they have? Do they have a moat characteristic, a patent on something that nobody can duplicate? All right, are they profitable each quarter? Or do they pay dividends for the past 15 to 20 years? Do the shareholders do they like the company? Is it a good, profitable company overall? This is what fundamental analysis is. The study of a company's financial and economic fundamentals to determine its intrinsic value. Its intrinsic value. Now, intrinsic value means something that's going to accrue money over time. You're not losing money, but you're making money. And you want to know how big the intrinsic value is. All right. Now this next one is calls, right? This is about options. Now, if you're not too familiar, I'll briefly tell you, we deal with contracts when it comes to trading options. Options is just another vehicle, right? Another vehicle to be able to trade. All right. So it's a certain market. All right. You have a futures market. You have the Forex market. All right. Commodities market, the equities market. You guys are familiar with some of these things. All right. The calls, right? The options, right? The options market, you can trade equities, you can trade Bitcoin, crypto. It doesn't matter. But the option, the actual thing about options is that it allows you to have leverage. So we deal with contracts when it comes to options. So that means for each contract, we get 100 shares. For each contract, we get 100 shares. All right. Can you guys remember that? All right. Remember, one contract, we get 100 shares. Now, the reason why that's so important is because I want you guys to understand how leveraged, right? Remember, we talked about leverage a couple of minutes ago whenever we went to the first couple of definitions and we talked about how you want to use that money. Now, I'm going to show you something here. All right. You want to see the option chain. This is where we buy options. All right. During options, we go and we check the option chain. And we deal with contracts and they have expiration dates. All right. You can buy into the future. And to the side here, all right, these numbers in parentheses, this is telling you how many dollars that the market can go up from current price. So if you see a 28, all right, market is saying that it's an applied $28 move towards the up or the downside. It's up to you to catch the trend. I won't go over that right now, but checking the chart and technical analysis, that word again, you'll be able to assess whether we're in an uptrend or a downtrend. So you can calculate a plus 28 or a minus 28. All right. So again, options are dealing with contracts and expiration dates. And once you click one of these dates, you see strikes. All right. Don't get confused about the numbers on the side. We'll focus on this quickly and we're going to get back to those terms before we end this video. Thank you guys for sticking around this long. If you've been enjoying, smash the like button. Hope it's bringing you some value. Thank you guys. All right. So here's the strike. So here's the strikes and you click on one of these strikes and then you go and click on the ask. And that means that you have to pay $1,246 in order to get 100 shares. So you get one contract. You take that decimal and you move it over 1, 2, and that's 1,246. Okay. So once you click that, you see here, this is the paper trading segment of Thinkorswim. So it's automatically programmed for 10 contracts, but you can change how many you buy. So I want to make it 1. And that means that I'm going to buy 100 shares of SPY at this price, $687. For $1,200. Now, just put that in perspective. If I wanted 100 shares of this without doing the option, I would have to pay $687 times 100. That's a lot of money. Most people don't have that. And so that's why options give you the leverage for you to be able to leverage a bunch of shares for cheap price. All right. That's what I wanted you to understand. And remember, guys, you can always rewind and come back to this. So don't be afraid. All right. And so call options. All right. A call option is a financial contract that gives the buyer the right, but not the obligation to buy the underlying asset, such as a stock, commodity, or currency at a certain price, strike price, what we just talked about. See, that's why I talked about it before we read. All right. So let's go back. A call option is a financial contract that gives the buyer the right but not the obligation to buy an underlying asset such as a stock, commodity, or currency at a certain price, strike price, on or before a certain date, expiration date. We talked about that. Now, it's a type of contract that allows the buyer to speculate on the price of an asset and potentially make a profit if the price of the asset goes up. All right. Now that's a call. Now a call in lame terms means go up. You want price to go up. That's the trade you're taking. That's what your thinking, your analysis is saying, your theory, right? All right. Puts is if you're saying you think the market would drop, and it represents a way that you can make money when it drops. A put option. Call and put go yin and yang, all right? Brother and sister, okay? Inside of the option chain. Puts. A put option is a financial contract that gives the holder the right but not the obligation to sell an underlying asset such as a stock, commodity, or currency at a specific strike price within a specific time frame, expiration date. Same as the call. We talked about this. It's just the opposite direction. Put and call. The holder of a put option can profit if the price of the underlying asset decreases below the strike price before the expiration date. All right, so I want to say this quickly. Just because you buy expiration date and it says March or whatever, 2027, it doesn't mean you have to hold it until March 2027. We're in 2026. All right, the price might go into your direction on a Friday, the next day. So you could take profit the next day and or in the same day. The expiration date only gives you a buffer for price to go in your direction, so that theta won't eat up your contract, because we deal with contracts and contracts expire and you don't want that to happen to you. All right. So again, the holder of a put option can profit if the price of an underlying asset decreases. That means fall below the strike price that you chose. All right. The buyer of a put option is called the option holder, while the seller of a put option is called the option writer. Put options are used as a way to speculate on the price of an asset or as a form of hedging against potential losses in other investments. All right. Supply. Supply on a stock chart refers to the number of shares of a stock that are available for sale at a given price point. Okay, supply. So this would be, for example, see how price fell from here? That was enough supply. The market pays those people distribution. It's distribution when it's falling, somebody's getting paid. And the opposite. Accumulating, prices accumulating, and then we explode. All right. But this is what supply is. When it falls, there's enough supply there. When it falls, okay, there is enough supply there when it falls. That's supply at these points where price drop. Okay. All right. Now let's get back to the terms. Supply on a stock chart refers to the number of shares of a stock that are available for sale at a given price point. All right. It can go the opposite way. Feel me? It is represented on a stock chart as a horizontal line that shows the resistance level, like what I just showed you, atop. The stock is having a difficulty rising above. When the stock price hits a resistance level, there are more sellers than buyers, resulting in a decrease in the stock price. A stock chart with a high supply level shows that there are many shares available for sale at the same price point, making it difficult for the stock to rise above that level. A stock chart with a low supply level shows that there are fewer shares available for sale, which may make it easier for the stock to rise above that level. Now that's supply. Demand. Demand on a stock chart refers to the number of buyers who are willing to purchase a specific stock at a certain price. When demand is high, the stock price will typically increase as more buyers are willing to pay a high price for the stock. On a stock chart, demand is represented by an upward trend of the stock price and a high volume of trading that indicates that more buyers are entering into the market and driving up the price of the stock. High demand can also be seen in an increase in the number of bullish indicators such as moving averages and bullish candlestick patterns, like the one that I showed you about the inverse head and shoulders. You remember? Do you remember that? Now demand on the chart, let me show you the way I show you supply. Okay. This will be demand. Remember we said that was the shoulder. This is the head. That's the shoulder. Demand is when price is accumulating. All right. Price is no longer able to fall like it's doing here. We have a trend here. Okay. Trend down, have lower highs and lower lows. All right, that's a trend down. Okay. And you also have trend up, higher highs and higher lows. All right. Remember, this is a trend up, a step ladder. All right, because price went up and it dropped, but it didn't quite go back down. It stopped here and it created a higher low because this price is higher than that one. Same thing. Bada bing, bada boom. Bada bing, bada boom. Higher lows, higher highs, higher lows. That's an uptrend. This is a downtrend. Lower pivot points, lower highs, lower lows, lower highs, lower lows, because this one is lower than that one. You with me? All right, so you see that downtrend, and once that breaks, it's a break in structure. It's no longer doing that step ladder. Down, 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 up, up, up. It's stopping right here, making a block. Now it's trading, changing trends towards the upside. All right, and right here is demand. Right there is demand. Buyers are stepping in and price accelerates. You guys with me? I know you with me. I'm glad you're enjoying this. Now, I'm going to stop right there. All right. We're going to stop with demand. That is all that I have for you guys right now, I would say. And the only reason why I say that is just because I wanted to give you a couple things. I didn't want to cram you with a lot of terms, but I did give you enough, just enough, I think, that maybe you want to come back for more and get part two. This is part one. I really do appreciate you guys watching. I hope that that little bit of information has helped you. All right. It was just a little bit, right? Not to cram you with too many things, but if you did enjoy the video, the things that I taught you, smash that like button, will you? I really enjoyed teaching you guys this, and there will be more. All right. Don't be afraid to leave comments below. Please don't be afraid to leave comments below. I talk back and I engage if you have any questions. And remember, give yourself some grace. Go back and watch the video over and over and as many times as you need to digest these things. All right. We're here for you. Again, I am Coach UV, and this is the Unique Trading Group, where strategy meets mindset and discipline turns into income. Until the next time, guys, peace.